Goldman Sachs are at it again. They're claiming momentum traders are going to buy all of the S&P 500 dips in all scenarios. But is this true to the smart money versus dumb money thought processes? Today, we talk about what's happening underneath the hood of the market, and more importantly, whether PIMCO is correct to say that bonds are better than stocks right now. We'll also be having a look at the inside candle ahead of the inflation number. The markets seem to be thinking that there is a direction that's about to happen, and it may still be bullish, even with exhaustion of 6 days up in a row. But the Nasdaq has continued to make a series of higher highs and higher lows, and at the same time, Treasuries might have just put in the low of 2023. Yes, the worst investment by many has possibly just bottomed off. Well, welcome back, everybody, to the Daily Show, where we discuss stocks, commodities, and cryptos together, including the macro and lead indicators, and of course, the hottest charts. We've got so much to talk about, but let's get started with what happened over the last session. It was about medical devices getting slammed, and of course, energy also getting hit. But at the same time, we had some resurgence in some semiconductors and of course, technology stocks. Now, a lot of these are coming and setting up for their key levels, which we'll look at later on. But let's discuss smart money versus dumb money. A lot of you guys like this chart, and it gives you a bit of an indication of sometimes when dips are being purchased. Recently, we talked about how we saw a pretty big resurgence of smart money purchasing off the low, and so far they've been pretty much injecting. There has been a small pullback, and that's probably in line with some take profits around the levels that we've spoken about over the last two videos. But dumb money is now starting to make a resurgence of the buy the dip. So what happens next? Well, a lot of the time we kind of rip up a little bit, and then we have a pullback. That's when dumb money reignites themselves and starts to buy. So the question then becomes, have we found the low of 2023? Well, we've been speculating on that being a real possibility. But for longer term investors, they're going to be looking at charts such as this. What about real equity premiums? What about the equity risk premium overall? S&P 500 forward earnings versus 10-year US Treasury yields or 10-year US TIPS yields. Well, it turns out that this chart isn't as bad as maybe some of the other ERP charts you've seen before. And they are starting to get down, though, where you are starting to expect bonds to outperform the stock market over a multi-year period. Once these get below zero, that's when you start questioning everything. But at this stage, it's an interesting chart in comparison to many other ERP charts that you'll see out there that are showing a very negative stance for stocks versus bonds. Let's move over to what the expectation is for inflation so far, and also some of the FOMC comment minutes before we go into the rest of the charts. It seems everybody thinks that 3.6% is where we're going to land up. So if we get something that is different from that with the inflation report, expect some volatility. Look for the VVIX, and then of course also look for S&P 500 to break some of the key levels that we'll be talking about later on today's video. FOMC minutes, the biggest thing here, I think, out of the post, I posted this on our Twitter X account, links in the description down below, was the majority of participants judged that one more increase in the target federal funds rate would be likely appropriate. What's the key here? One more, okay? Not two more, not maybe we'll see a few more, it's one more. Let's talk about bullish percent index. We speculated we saw the lows of the market last week with some of the action that we had on the charts, and it obviously seems to be that way. So far, we've had a significant turn in the bullish percent index, similar to previous times. And you know what happens here? We usually get an uptick and then a pullback in the markets. So a lot of you will be waiting for that pullback, I'm sure. And we have thought that the market was exhausted the last 1 to 2 days and just hasn't been able to turn around just yet. Longer term investors, again, will be focused on this type of stuff. I've talked a lot about zombie companies. That is, companies that can't even finance themselves. They have no profits. They have no way of getting out. And it seems like a lot of these are starting to go bankrupt. So filings are surging to dangerous levels, and we know this is probably one of the biggest problems underneath the hood. 2020, obviously, with the crisis, 2008, and look where we are in 2023. Higher for longer rates are only going to exacerbate how many bankruptcy filings we see. And there's so many companies. In some speculations by bond traders, they believe 15% of some stock markets are actually zombie businesses that cannot even afford to pay for themselves. So this will be an evolving story. Make sure to subscribe as we cover that story throughout the next year. Let's talk about CBOT Fed fund rate futures here and what's going on at this stage. So we've seen a little bit of a drop, and that basically is telling us that even if we do have one more rate hike, we're expected to now see rate cuts as early as potentially March of next year. Now, this is much better than the June, July that we had before. And of course, this is changing everything. It's changing what our expectations for gold have been, which has been positive recently, especially the last couple of days, and it's been absolutely destroying from that. And do remember, it is not what you read in the news. It's not so much, oh, yes, a rate hike's happened. By the time you hear about it happening, it's already occurred on charts such as this. We'll give you an update in the next video, and I'll post it over on our Twitter X account as well, so follow along there. Do remember, it's not just about inflation this week. In fact, I could see inflation being a relative fizzer, and more importantly, it's probably on the banks. Citi, Wells Fargo, these ones are coming out first. Do remember as well, we've got Tesla and Netflix next week, and it's earnings season kicking off once again. And by the time we get to the end of October, we'll know a lot about how the market wants to trade for the rest of the year. If it wants to continue to rally through all the way to Christmas, or whether it's going to have a bad time. You know, the interesting thing though for bears out there is that pre-election years tend to have these strengths in them, but basically the election years themselves are all over the place, up, down, and all around, and usually a subpar kind of gain on the S&P 500. So there's still a lot of activity, I think, as we move forward to probably what's going to be eventually a recession being called. And before that point, I'm sure the market starts to freak out about earnings. Why is earnings the most important? Well, pretty much all the banks or all the economists think 4 of the large 6 banks are going to be bad. So Wells Fargo and Citi, well, Wells Fargo doesn't tend to have a very good track record. So we'll see. That's why expected volatility is so high. 6.5% expected move on the Friday for it. Be careful out there, guys. Treasury's oversold 2 standard deviations. I just keep rabbiting on about this chart because it's so key. It told us that we were in a critical point. And if you've been watching the channel for a while, you'll know I love a good standard deviation play. The same thing with forward PEs, the same thing with everything. One of my favorites. Thinking the opposite of other people, but only when times get incredibly tough. And in this case, treasuries, we just saw the worst sell-off of all time. So, of course, that's partially why it's such a big key here when we get these 2 standard deviations. Have we seen the lows, though? We'll bring up the chart later. New sentiment report in the next video. I'm excited to bring that one to everybody. I think it's going to be really key on how we're going to move next. 41.6% bears last week, and of course, bull-bear spread was -10, showing us that we probably expected a bit of a rally. Now, if you're a bear, again, where are we right now? Well, we're trading into the middle of the month, and in pre-election years, this is actually where we tend to get pullbacks. So we've had a pretty ripping rally. We've seen dumb money, which is usually us, starting to say, "Oh, I like this. I like this rotation. I'm feeling pretty good about this market condition." And we're about to get potentially a gap fill on the S&P 500 that we'll talk about later. So could we be looking at a bit of a pullback into the kind of late part of this month and then a rally? Well, I think a lot of that does make sense. However, it is not a guarantee. And of course, you need to get price action coming along with you. In terms of the end of the year for medium-term investors, they're going to love that stat. We've talked about it many times. Basically, it's been a 100% track record of having success around that period, and we'll see whether it can hold up. Dark pool activity and generally big trades, there weren't that many actually today, and the session was pretty weird from that aspect. And a lot of it has to do with people and even big funds. They do tend to actually usually implement their strategies after the news. Like a lot of us retail traders, we're going to predict. Well, a lot of them are positioning based on the news events. So that's why you often do see a lot more transactions on the day itself. Number 14 read here for treasuries, a large trade. I don't know if it's the high point for it. Personally, I think that there's a lot to say that treasuries are getting towards just such a tasty level. And with the shorts outstanding on treasuries, it's going to be a very key squeeze in the future. And maybe we're already seeing the start of that squeeze. Again, we'll look at the charts very soon. All right, let's move over to the wonderful world of options. Did we see anything interesting here? Well, we're just looking at some of these ones with the huge moves. Take a look at McDonald's here. 80,000 puts in comparison to only 9,744 calls. 4.28 times 90-day volume and only down 0.2%. An interesting point for sure to be looking at them on the charts. Some other things that I think are interesting as well is Disney right now. We're starting to see calls again kind of coming through here for Disney, but it wasn't really a big day. I just think that when we're looking at the charts, and we'll go to it later on, you've seen so many calls for so long getting burnt on Disney. And I'm starting to see a little bit more of the put side coming in, which again could be putting a wall underneath it. PepsiCo, with earnings kicking off, was down 1.1, and of course 5.72 times volume, 88,000 puts in comparison to 27,000 calls. So some interesting stuff here. Again, we're seeing a huge amount of calls coming into treasuries as well. So treasuries could be on the squeeze against all of the monstrous shorts that have been outstanding for a while. So I don't think this tells you the full story of how many puts truly are on treasuries and have been oversold. From the options perspective, we have an absolutely even day. 50% puts, 50% calls on 34.4 volume in comparison to the 39.5 we usually see. So a weak options day, expect that to totally change on Thursday with the inflation numbers coming out. Let's have a look at rotations. Gold did really well, and one of my favorites recently, which has been utilities. Hey, it's nice to be up there, 1.62%. So actually two of the favorite sectors that we've been talking about pretty much for a week, they have done amazingly well. Poor staples, so low. Healthcare, not doing so good. And then, of course, you've got all the normal ones. Sometimes it's nice to see a sector that isn't technology and semiconductors doing really well. Have a look at gold's run, 9.3%. Hey, it was due it after such a ridiculously bad thing. But you know what happened here? It was yields. Everything changed when we saw the yields start to make their switch. And that's on the long-term curves, and especially on the 30-year and 20-year, which we'll look at soon. But look at that, gold 9.3%, utilities 4.9%. Now, of course, you go 2 weeks back and you'd be like, wow, these are the worst sectors ever known. But they've had some strong recoveries in them when you've waited and been patient for those moves. Staples starting to look a bit disturbing, and everyone's writing articles about how great staples are. That probably means we need to look at them soon, but maybe not just yet. And we'll discuss that in future videos. US 30-year, this is a huge deal. If it closes this way, we've got an engulfing candle towards the short end, and that basically tells us that we may have seen a topping in yields. And some of my lead indicators have already been saying that for about 2 weeks, which is why we've kind of been going with this yield narrative of switch going on. 4.558 on the US 10. And of course, you'll want to keep on this one here, which is US 02Y, US 10Y on your charts. And that's going to tell you if we are going to see an official recession. Generally, you never see one of those until you go underneath one. The only reason I say it's very likely is because of how long we've been inverted for. I think this is like the longest in history, or the second longest in history. They've always caused some type of recession, whether it's minor, whether it's major. And just remember, recession is an overblown word. It's really what exactly is happening during that recession. Are we seeing jobs absolutely getting mauled? So many things and so many pieces to consider. For all the S&P 500, it has been injection by the Fed and injection by central world banks. No wonder we found the low, and also we saw smart money buying up. This is, I think, a disgrace. But anyway, they keep propping the markets, and that's what's happened. I mean, it is what it is. That's a huge injection. We saw similar injections when things broke last time. And I still maintain something broke. Maybe we don't know about yet, but something broke in the back end, and they injected to support it. Because whenever we see yields go as high as they have been, as fast, and that momentum shift, and of course the fear of the unknown start to come in, that's always been a time when we've seen that injection just randomly come out of nowhere to support the markets. I wonder why, hey? Call me a conspiracist, but I think it's pretty clear that it's happening. Let's have a look at the MOVE index here. And we've got the bonds market and 127 in terms of MOVE. It's coming down. So again, volatility is starting to come out of this market. This will most likely spike, or at least the VIX will spike unless the inflation number looks really good. You can see here the VIX dropping back down to 16. And we only got a 20 read on the VIX this time. Usually you'd expect a 25 plus, but yeah, we just didn't see that incredible fear. We saw capitulation, but not incredible fear. Let's move over to treasuries. Now, a few of you have been sending this in saying, Tom, is that an island reversal? I guess you could claim it is. You've got a gap down, you've got a nice basing formation, and of course you've got a gap up here in treasuries. Nice strong day for it. We're going into the 20 moving average now at this stage. We might find some resistance around there due to this also being supply. But in general, this volume is hard to ignore. Huge trades going through. Treasury is just getting absolutely mauled. Put it on a weekly chart just to put it in perspective. And it got slaughtered over here, had a nice recovery. And again, It got absolutely mauled, even past our 88.90 zone, which obviously was a zone that we've been looking at for a long time based on those previous histories. Look, this is pretty much as low as you would have expected to go. Somewhere around 84 to 81 was pretty much the lowest I ever expected Treasuries. And if you'd asked me again where I thought it would stop, I would have said 88.90. But again, this is why you don't really predict. Instead, you say, okay, well, that's a possible zone for us to look at. And then you look for market structure. All right, let's move over to copper and take a look at this one. Even the Chinese stimulus packages haven't really moved copper too much. Again, Dr. Copper tells us a lot about the world. At the moment, we're in a demand zone and we've been in a downtrend. So we're looking for this to actually break through this trend line here. And if it does, that's actually a positive sign for bulls in the market. And I think things will be looking a little bit better on the markets themselves. Dow Jones Transportation Average Index is again starting to put in the bull moves here. It got above that 20 moving average. It's telling us that the market is meaning business here. It's saying, you know what, I think this is a bit more of a recovery. We've got home builders, not quite through our alert level yet, but this is again saying this recovery could be real. And where do we find ourselves? Critical points. Why? Because it's ahead of inflation. And of course, inflation's coming out in less than 24 hours, plus the kickoff of earnings season. All of these levels are going to be super important for the next couple of months. Semiconductors still maintains in our golden pocket here, and you can see the supply is holding. It was a little bit stronger than I thought. We ended up getting that rally into short. And then you know what? There was just no sell-offs. There was no breaks of anything in the previous session. I saw a few people shorting some scalps and they got it right for part of the session. But by the end of the day, the market was obviously well back up. So they either got broken even or basically just got stopped out. Or maybe even got some profit if they took it early. But yeah, semiconductors sitting in this supply. So again, all heading into inflation numbers. Same thing with what we're seeing on the US dollar. The US dollar may have topped out. We've been talking about that. But have a look at this demand zone. Bam, straight into it, sitting here, waiting for more information. And again, we won't really make a prediction there. We'll see how the inflation number plays out. Let's go over to gold, and it hit our target. So for anyone that was bullish on gold, congrats. First supply hit, beautiful level. Actually saw a little bit of a rejection off here, but I haven't really seen enough to show us that we're going down just yet on gold or anything. And I think you won't probably get a read on this until after the inflation report. Some people will be looking around that 1867 and then saying, okay, well, if we go underneath 1867, I want to look for shorts into 1850 levels and the previous demand. That's valid, but we are at that key supply. So I think some people will say, well, time for me to take profit and then reassess. And we'll be reassessing gold very soon. Gold stocks, absolutely booming. Next target is, of course, 29.80 for gold stocks, and they're behind spot. So they could go up even if spot was just, up and down $10 for a little while. US oil, now it's dropped back down to a level that we thought it might, but at the same time, it didn't hit that supply that we were looking at trying to get a sell through. So will we see buyers in oil here? A lot of it's going to do with the CPI inflation number. I'm actually negative on oil, which I've spoken about many, many times, especially when we saw this. When we saw this, we basically went, okay, probably top of yields, because oil was predicting in this case, and it was basically front-running yields. So we saw that crash through oil. Then, of course, everything happened over the weekend, and then we saw that rally. But that's always going to be short-lived. And my expectation was about 89 for that, and then maybe we would sell off. And that's still live. It's possible that we find buyers here, we move up to 89, and then we see sells. But have a look at energy stocks. They were getting slaughtered. And this is exactly what I kind of think is going to be happening here. We're down 1.29. It was down a lot worse before. It's gapped up, then it's actually gapped down. So interesting point here for energy stocks. I'm not doing anything with them in particular, but some people are going to be trying to go short here. And actually, look, there are cases to be said that maybe buyers are going to try to buy in these zones. I'm not buying or selling for energy, but I do think that there's a better chance that energy stocks actually may have seen their peaking through the recent cycle, at least for now. Though, we'll see what happens with yields. Yields have a lot to do with this. Let's move over to Tesla. Tesla at this stage has held in its zone and nothing much to say. It's making a series of higher highs and higher lows. So basically it's up, 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 up. At this stage, if we get a turn, hey, we'll be the first to talk about it. Let's move over to AAPL. What's going on there? No break of the new high yet, but we're ahead of CPI inflation numbers. So, of course, we have to expect that this may break. And if it does, it's a very positive sign for the markets in the future. Again, when we see probably an inevitable pullback, that should be met by bull demand if that's what's going to happen. For bears, they need to take advantage of this market right now and sell it off very, very quickly. Disney's another one I want to bring up for a little while. It has hit, of course, that critical level that we talked about for ages, and it finally hit it a few weeks ago, and basically we've seen some nice strength resurgence here. So we're looking for potentially Disney bottoming off here, and this is a very critical point. And you know what I saw the other day? I reckon it was peak fear. There were so many people going negative on Disney. And don't get me wrong, I haven't seen a Marvel film for probably about 4 years, and I don't even want to anymore. And I used to watch them all. But God, I'm so sick of them now. But it's like those old cowboy dramas, the ones that were from like 70s and stuff that got saturated and then no one wanted to watch them anymore. I'm sure some people still do, but yeah, they were always in the dollar bin on VHS. Anyway, Disney over here, we have a big resistance, and this is a key level for us to break through if we're looking for positive price action. I think Disney's a case of putting our own opinions at the door. So even if you're negative or positive on the company, ultimately you just trade the price action. And it's really a good lesson, I think, for a lot of people. Another lesson would be utilities. Here is a market that you would not think would get destroyed like it did, but it did. And it put in some massive volumes the other day, which you can see down these lows. We've been positive on it the last maybe 4 or 5 sessions. And it's doing really well. It actually surpassed first TP. And I still think there's even more in it. It's basically V-shaping from a brutal sell-off. And now it's squeezing a lot of those shorts back out. It's kind of similar to treasuries in some ways. RK, hypergrowth stocks, not a good session for them, but that's okay. Expected that this would happen. And we're kind of hoping for it to actually get down a little bit lower, maybe like a 39 or something. And then we'll see whether the buyers can recommit to it. But it seems like it may have put in a low. And it's certainly just showing you there's a lot of opportunity in this market. Even if the market runs off, yeah, the big tech stocks might go first, but there's going to be a lot of opportunity throughout so many subsectors. You've got potentially staples in the future, utilities, you've got gold. There's so much opportunity in these markets. Let's have a look at the Australian market now, and it looks pretty strong. Basically, it's broken through our little green box here, and it's kind of pointing towards, again, the market rebound or anything that kind of comes from a sell perspective being bought back up, and that's kind of a positive. When we move over to US 2000, we haven't got a break of 1810 yet. We're still on the 20 moving average, which is the key level ahead of CPI, and we obviously have the downward trend line. I really like this chart in terms of in the future when we get to these trend lines and these levels, but at the moment, hard to say too much. CQQQ doing well as well. Thank you to Chinese stimulus, and it's up another 1.19%. And again, they're just defending around this level, which we've speculated on before. It's basically back to that break-even zone where we started to first speculate on it. NASDAQ, 15,263, new high. So NASDAQ very strong, getting through the top of that supply. I don't know if I'm going to look at the NASDAQ here in terms of the chart to watch over the next 24 hours. I'm probably going to use the S&P 500, but it did manage to put a new high in. I'm going to go 15,114 as being a line and an alert I'm going to set over the next 24 hours to see whether the market's topped off. You can see there were some sellers here, and they've been squeezed out. So if the market wants to keep going up, it can do so. But if it's going to sell, I would be looking at market underneath here and then going for some weakness for now. Again, that's against the current trend, so you got to be careful there. S&P 500 inside day, as you can see, it didn't really do much. It sold most of the session, and then boom, boom. In the last two kind of candles here, we've got a little bit of strength. You can see the futures market is tipping over the top here. And just to go back, there is a gap fill at 44.02, which could be hit during the inflation number. So what if this happened? What if we went 44.02, sell off, and then started coming back down? Well, let's speculate on that. I talked to you in the private community about this, in the private trading community, and I said, that the problem was that we hadn't been able to make any lower lows. We're basically just making a series of higher highs and higher lows, and we've been doing that the whole time. So we've got the higher high, we've got the low now where we saw it got defended. So we'd have to actually kind of see that to really, maybe even have to take 2 days for us to actually see a proper turn towards the short. I'm sure some people will be sitting around 44.02 saying, I'm going to try shorting that. Yes, yes, yes. And you'll notice I have a green line around this zone as well. So between 44.02 and 44.10 will be kind of, I think, a critical bear zone for the next 24 hours. Good luck out there on that one. It is going to be a little bit tough to predict, but of course, this is what inflation numbers do. They often push in one direction and then reverse. The key will be whether the number is clean or not. If the number's super far off the 3.6 expectation, expect kind of a clean move. If the market's right on, expect the market to do some traps and all of that good stuff. Let's move over to crypto. Now, Bitcoin certainly looked weak for the first time in a while. It's been putting in a series of higher highs and higher lows and kind of like holding through. And then it broke our little trend line here and it's coming back down. Most trade level 28K. We obviously were looking for potentially a short that would come through at 29.5 to 30K. Well, it doesn't look like that may happen now. This is kind of weak. Another thing I want to see is I want to see Ethereum drop its low. So you'll see here Ethereum, no alert set for that. It didn't weaken anywhere near as much as Bitcoin yet. So yeah, I think, look, everyone's getting a little bit bullish on Bitcoin. I've said this for a while. I'm not really doing anything with it yet. I do have a bullish maintenance on next year, but yeah, I'd like to see it kind of wipe first. So we'll find out. I mean, kind of hard chart to read, really boring. I mean, if you were a crypto trader right now, you'd have to be in alts, and even then, yeah, I find it quite boring at the moment. But that's all right. We cover it, and we're going to get excited about it when it is time to get excited about it. Down here at 26K, I'm sure some buyers will be, but at this stage, it kind of looks weak after that trend line breakout. And yeah, I'd expect like maybe if we got like a pullback to these supplies and here small time frames, maybe we'd see shorts. All right, guys, that's the big stuff. Of course, news is coming up, and we know it is earnings and CPI. So be on top of the CPI report, 8:30 a.m., 1 hour before the market opens Thursday. Then we've got prelim UOM consumer sentiment, Friday, October 13th. And of course, the big earnings is just about to start kicking off. So stay on top of it all. Remember to subscribe and smash that like button if you want to follow along with us. And we'll be covering all of earnings season. Bye for now.